Hi, today we're going to talk about one class of adjusting entries called prepaids. If you remember in your text, adjusting entries are classified into two types, prepaids and accruals. The difference between the two relates to when the accounting event happens relative to the cash event. With a prepaid adjustment, the or prepaid expense or unearned revenue, the cash event happens before the accounting event. The simplest of these that we can talk about is when we prepay for a service. In this case, we're looking at January 1 through December 31st. On January 1, we purchase a 3-year insurance policy for $15,000. When we do this, we debit prepaid insurance and credit cash. Notice prepaid insurance is a current asset account. The logic behind this, in other words, the reason we're not debiting insurance expense is because we have purchased a benefit. That benefit is we get insurance coverage over a 3-year period. We should allocate the cost of that coverage over that period. When we first purchase the insurance, we haven't used any of the asset. In other words, we haven't actually received any coverage. Because of this, we can't debit an expense. We have to create an asset account which signifies that we are going to get a benefit over a 3-year period. You notice that the prepaid insurance account here has a debit balance of $15,000 at the start of the year. On December 31st, 1 year has passed, which means that 1/3 of the insurance policy has elapsed. In this case, what we do is we expense 1/3 of the asset. We debit insurance expense and we credit prepaid insurance. Here we're crediting prepaid insurance. The new balance in prepaid insurance at the end of the month is end of the year is $10,000. So we still have 2/3 of that asset remaining. Let's look at this from the insurance company's point of view. If we prepay an insurance policy, what that means is that from the insurance company's point of view, they have unearned revenues. Just like we have not received the benefit yet, the insurance company has not provided the service yet. Because of this, they can't recognize revenue when they receive the cash. Here, unearned revenue is a liability account. Again, if we look at the purchaser, an asset account is created, and that asset account slowly goes away over time, and we simultaneously recognize the expense as that asset account goes away. Here, we're receiving cash of $15,000 and we're creating a liability account called unearned revenue. As that liability diminishes, we get to recognize the revenue. So in this case, unearned revenue starts out with a balance of $15,000. At the end of December, a year has passed, so we have provided 1/3 of the service that we were contracted to provide. Therefore, we debit unearned revenue, $5,000. That's 1/3 of the $15,000. And we recognize service revenue, in this case insurance revenue, of $5,000. So from the standpoint of services, a prepaid expense has a mirror image in an unearned revenue. Notice the unearned revenue account starts with a credit balance of $15,000. It goes down $5,000 during the year, and we end up with a credit balance of $10,000. Those are two very basic kinds of prepaids. Again, with the revenue side, we typically call that unearned or deferred revenue. However, there are prepaid expenses that involve physical assets. We can prepay a short-term asset, or we can prepay a long-term asset. Let's take a look at the situation where we prepay a short-term asset. In this case, we're buying supplies. At the beginning of the year, January the 1st, we purchased $15,000 worth of supplies. We debit supplies for $15,000 and we credit cash for $15,000. Our supplies account has a $15,000 balance at the start of the year. Now, unlike the service transaction, where the reduction in the asset account is a function solely of time passing, with this asset account, the reduction in the asset is associated with actual usage of the asset. So, from the standpoint of supplies, we take inventory at the end of the year. We find in this example that we have $250 worth of supplies left. Or another way of saying that is that we've used $1,250 worth of supplies. And we have to do an adjusting entry reflecting the fact that $1,250 of supplies have actually been used. So in this case, we recognize a supply expense and we credit supplies. The supplies account has gone down by $1,250 and the ending balance is $250. In a problem in the text, they can specify supplies account has decreased by $250, in which case they're telling you the amount of the journal entry directly, or they may tell you the beginning balance of the supply account was $1,500 and the ending balance was $250, in which case you have to infer how much supplies were used during the year. So the key element with the short-term purchase, or the purchase of a short-term asset, is that we directly credit the asset account as we recognize the expense. Notice on the revenue side, for when we purchase assets, unlike when we purchase services, there is no analogous unearned revenue. The reason for that is when you sell supplies, that's the actual sale transaction, so the revenue would be recognized immediately. What about for long-term assets, in this case equipment? Let's take this example. On January the 1st, we buy $50,000 worth of equipment. This equipment, in our example, will be depreciated down to zero over a 10-year period. When we purchase the equipment, it's a debit to equipment and credit to cash, very similar to what we did before with supplies. The equipment account has a $50,000 balance. At the end of the year, we depreciate the equipment 1/10 of $50,000. That's $5,000. So the adjusting entry is slightly different than in the previous example. In this case, we do debit an expense, in this case depreciation expense. However, we do not credit the asset directly. Instead, we credit a contra asset account called accumulated depreciation. Notice this has a credit balance. The reason for this is obvious once we see how the assets are reported on the balance sheet. At the end of the year, the supplies account is reported at its net amount, $250. The equipment account, however, the historical cost of $50,000 is still reported. We subtract the accumulated depreciation, which is again our contra asset account, and we show the equipment net book value of $45,000. On the books, the value of this equipment has fallen $5,000, but we don't credit the asset directly. We show it as the difference between equipment and accumulated depreciation. Now, why do we have a different treatment? Why don't we just credit the equipment account directly? Well, the reason is because with the supplies account, the $1,250 of supplies resulting in an ending balance of $250, those $1,250 supplies have actually gone away. We've actually used them up. The equipment asset, however, is still on the floor. We still have it. So until we actually dispose of that asset, we're not going to take it off our books. Therefore, we always report the historical cost of the asset and we reduce it via this accumulated depreciation account. So that's our video on prepaids, prepaid adjustments. In the next video, we'll talk about the other class of accounting adjustments, which is accruals.